Okay, welcome to the show, everybody. My name is James Faulkner. I'm here with Jim Mellon. Welcome to the show, Jim.
Thanks, James.
How are things in the Isle of Man? Is there any signs of life over there?
I would say the economy is almost fully restored here, actually. And on Monday, all the pubs and hotels open as well. There have been no cases here for 21 days. And the construction industry is in full flood. All the shops are open. I would be very surprised if the Isle of Man has a recession this year.
That's good to hear.
Yeah.
So the markets have had an absolutely terrific run over the past few months. Are they getting ahead of themselves, do you think?
Yes. As you may remember, the last time we spoke, I was recommending that people bought some of the fallen angels like IAG Group, Delta, and that they played what was bound to be a cyclical recovery, and some of the main names in travel, tourism, hospitality. Some of those stocks have gone up have doubled basically. And I was a little bit worried because Warren Buffett, as you may have seen, James, sold all his airline stocks.
Yeah, saw that.
Since he sold those stocks, they're up between 70 and 100%. So he may not have the touch that he once did. But the fact that they have become, there's been a feeding frenzy when there is no actual return to full flights and hotel occupancy is indicative of just that it's an excess of money, or at least there was an excess of money chasing any theme that came along. So I think we are re-entering dangerous territory. And one of the key things to watch for is that the VIX, as you know, is the measure of volatility.
Yep.
And I'm sure master investors are familiar with it. And when it goes up, there's more volatility. When it goes down, there's less volatility. But the VIX has been going up in a rising market, which is a bad sign. And I would say that time to be cautious. There are some areas that I like. I like the financial stocks still in some cases. They've had a bit of a run, but they're still incredibly cheap. So if I might give you some names, I'll give you Lloyds Bank here in the UK, which I had to suspend its dividend, but not because it couldn't pay it, but because the government forced it to. I think that remains remarkably cheap. And an old colleague of mine, Jeremy Hosking, who's a very good fund manager, has written to Lloyds and told them to pull their finger out, and he's bought a lot of Lloyd shares. So I think there'll be more and more activism in that area. They're not owned by the British government in any way now, but they are actually dominant in UK, well, the dominant bank in UK retail. And we're not going to have a housing collapse, which would be very bad for them because they're a big mortgage player. I don't think we'll have negative interest rates in the UK, which would also be bad for the UK banks. And they're selling at a fraction of their book value and on a very high prospective yield. So my view is they're a good buy. And then you can add to that Phoenix Group, which is a buyer of zombie insurance schemes. That's got a very nice dividend yield. It's a very well managed company. Andy Briggs runs that, and it's a big company. It's quite liquid. I would, say that that's on a prospective yield of around 7%. RSA would be another one that I would suggest that people have a look at here in the UK. And then on the continent, Allianz insurance company in Germany, to me, looks cheap, as does Swiss Re in Switzerland. And if you really want to take a punt, I would buy the French and Spanish banks. So the ones that come to mind would be Société Générale in France, which is a universal bank. It's pretty well run and it's incredibly cheap. And then BBVA or CaixaBank in Spain, both of which are on very high prospective dividend yields, and both of which I think, and all of them actually, the continental banks could rally by as much as 30% over the next year.
Yeah.
So I think those are interesting.
And what about gold stocks? Because gold stocks have pulled back a little recently, haven't they, as well? But I'm guessing that you'd be a buyer at this point on the pullback.
I've been banging on about gold and silver, and today we're having another run in gold and silver. As you rightly point out, the gold stocks had a big run. I mean, the one that I'm a director of, Condor Gold, went up 3 times actually, and now it's only up slightly more than twice, having raised some more money. I would say they were a little bit ahead of themselves, but the pent-up demand for gold and silver is huge. And as you know, I feel that we're going to go into an inflationary period after this deflationary shock. And so gold and silver are the obvious things to do. Now, gold today, the last time I looked, was about $17.25 an ounce, and silver was knocking on $18 an ounce. So my prediction remains, by the end of this year, $2,500 an ounce for gold and $25 an ounce for silver, which represents significant upside. And I don't think there's a lot of downside in a world of very low interest rates for either of those commodities.
Do you think that we're reaching a point now where the current monetary system is on its last legs, basically, and we're going to see some that being replaced in some form or other in the next few years, maybe?
Well, that's a great question. I mean, we won't be replaced by Bitcoin. I don't think that the cryptocurrencies or any form of crypto that's introduced by central banks will take over from the current fiat money. But what will happen is that there's going to have to be some financial restructuring, because the amount of debt that's been accumulated by governments in this crisis is phenomenal. I mean, if you look at the ECB balance sheet, it's up, I think, 4 times since 2008. Similar figures out of the Fed in the US. The UK is a pretty impressive increase in the balance sheet. And what's happened, basically, is that central banks have bought the bonds of their treasuries, and that has sustained low interest rates. It's injected money into the economy. It's had the desired effect, but at some point they're going to have to stop doing that. Now, they won't unwind it necessarily, but they won't do any more of it, because they know that they'll be creating inflation if they carry on. So what I would think is that the idea that's making the rounds is that there would be debt forgiveness between the central banks in countries and their treasuries, and they would just wipe off the debt from one to the other. That's a possibility. And because banks own so much of their respective governments' debt, that would reduce the percentage of GDP represented by government debt dramatically, and improve the sort of the financial system or situation of countries quite dramatically, without, in my opinion, having any negative consequences. But this injection of liquidity, which represents a transfer payments to individuals who've lost their jobs and companies that are in trouble, has got to come to an end sooner or later. And I said to you the last time we spoke that I thought that the COVID-19 boat had sailed, and indeed it looks like it has. There are some new outbreaks in the United States. There are increasing outbreaks in Latin America for the first time. There's been nothing really in Africa of any consequence, but Asia's got it under control. It looks like Europe's got it under control. It looks like we'll be going back to normal. And it looks promising on the front of vaccines, particularly for the Oxford vaccine, which is in trials at the moment, and could be available, according to Astra, which is the partner of Oxford, as early as October on a mass scale. They're making 2 billion doses of it now in anticipation of it working. So I think we have to assume that this is going away, but that the recovery, largely because people are frightened, will be maybe not the sharp V that some people are thinking, but a sort of narrow U rather than immediate back to normal recovery. But it's been very interesting.
And given
I don't know about you, I'm getting very bored. I mean, I just want to get into, even if I don't travel, I want the opportunity of traveling. I want to get on a train, or I want to go on a plane. I want to do something.
Yeah, sure. There are only so many things that you can do stuck at home, I suppose.
Well, we're not stuck at home in the Isle of Man. We can do whatever we want now. We can, there's no restriction on movement or going to the office. But it's a small place, and it's, although it's lovely, it would be nice to, go and visit the dogs in Ibiza, or go to Berlin. Anything really. Maybe we should set up a tour group at Master Investor.
I'm up for that, Jim.
Yeah, but we need new ideas.
Just going back to the theme of inflation, we talked about gold, but what about the rest of the commodity space? Is there anything else in there that interests you? Maybe, the base metals, that kind of thing?
Yeah, that's a great question. So China seems to be moving at pretty well full tilt at the moment, but its domestic economy is not enough to sustain the absorption of raw materials in the pace that it used to. Because, they've lost a lot of export potential due to the downturn elsewhere in the world. And also people are moving production out of China to Vietnam or indeed closer to home. So I don't know, but and iron ore as a result of what happened in China is up. People are talking about copper as being a good investment. And it could well be that they are. I've got shares in Rio Tinto, which looks attractive to me at the moment. And at a smaller level, I've got shares in an Australian copper mine called Venturex, which just actually raised some more money today. And that has got a ready-to-go copper mine, which I'm sure will be a very attractive proposition. It's one of those mines that's was extant in the 1920s, so a lot of the infrastructure is already there. It's in a good location, very big reserves, all proven up, and it's got its environmental permit. So I would say Venturex is one for master investor people to look at. It's small though.
And what about oil? Because that's been an interesting one lately, hasn't it? I mean, are we at the twilight stage for oil? I suppose that's pretty obvious at the moment, is it?
Well, I don't think we are at the twilight stage. I mean, now that there's been some economic recovery, the price of oil has gone back up, and the usage of oil is going up as well. But I think what happened was that the US shale sector, which has developed in the last 10 years, as you know, completely destabilized the established powers in the oil fields. And then this COVID crisis came along, and if you lose 10% of your demand overnight, there is nowhere to put the oil, which is why you had negative oil prices, because people literally couldn't give the stuff away and actually were paying people to take it away. Now that has rectified itself. But what I think will happen is that the oil majors will try and reinvent themselves, and they'll do two things. One is that they'll continuously reduce capital expenditure in their businesses, because they know that over time oil will be replaced by electric power, or in the transportation, or by other forms of energy, including the alternatives that we all know about. That will mean that they will start to cannibalize themselves. So I think you'd see Shell, BP, Total, Exxon in the future paying out bigger dividends as they dismantle.
I was just going to say, is there actually the potential there for these companies to become really good investments in future? Because they, as you say, if they're winding down capex and things like that, they've actually got huge cash flows. So presumably a lot of that could be returned to shareholders over the next few years or so.
Yes, and in fact, if you imagine them like a sort of self-liquidating trust, that could be the way that they will be. And so you don't look at them as being growth stories. You look at them as being companies with substantially undervalued assets that are realizing those assets and gradually returning them to shareholders. So I'm a bull of Total, Shell, BP, and we've got holdings in all of those.
Okay.
I don't know enough about the small oil companies to have any real view on it. But I do know that I've got something in my portfolio called Hurricane Energy, which is a North Sea producer, I understand, which is very highly leveraged. And I don't know why I've got it, but I've got it. And it's one of those short-term investments that's become a long-term investment. I'm sure we're all familiar with those.
I'm sure everybody's familiar with that situation. Yeah, so moving on to something a bit different. You like your meta themes, your money trees, as you like to call them. Has anything been going on in that space recently, especially in the?
Yes, James, that's another great question. So in this pandemic, looking at the US, which is always the leader in consumer products around the world, or I say always, but mostly the leader, you've had Beyond Meat. One of the stocks has in this area, in fact, one of the very few stocks in this area has gone up dramatically because the slaughterhouses in the US were particularly badly affected by COVID-19. And they were badly affected because these pandemics spread in very cold conditions, and the slaughterhouses are cold, and the people work, and they're typically poor people, work in very close proximity to each other without adequate protection. So people were dropping like flies from COVID in the slaughterhouses, and a lot of them closed down. That meant that consumers who were eating at home mostly weren't given the opportunity of buying fresh meat. I mean, I'm talking in general terms here. So they increasingly tried out the plant-based burgers that are the only things on the market at the moment, because you can't buy cultured meat products yet, although you will. And as a result, you know, the sales, which were forecast by Jefferies, a big investment bank in the US, of Beyond Meat to be about $1 billion in 2030, which is, as you know, 10 years away, are expected to be $1 billion, tracking $1 billion by the end of this year, 10 years ahead of expectations. So I think consumer adoption in this area will be much faster than people think. So you've got, in the US milk market, alternative milks, soya milk, almond milk, oat milk, rice milk, has already got 15% of share in the United States in the last decade, up from nothing. In the alternative meat market, it's about 1% share. So brands that you might be familiar with would be Quorn as an example, yeah. Beyond as another example, Impossible Burger would be another example. And they're all coming out with these plant-based meat brands.
And is meat to buy at this level, do you think?
No, I don't think so. No? I don't think so. I mean, I think that, you know, it's an $8 and a bit billion market capitalization. I think that's quite expensive. Because even if it has a sales of $1 billion this year and it makes $100 million, let's say, net profit, you're talking about 80 times earnings, and there's better things to buy. But the whole area is taking off like a rocket, and the science is advancing very quickly. So in this lockdown, I've been writing a book, and the book is called Moore's Law. It'll be out, let's say, early August, and it's about this area. And yep. So what we've done is interview all the key, like I did for Juvenescence, but remotely, interview all the key players on the in the area, and and the money is coming in. So, for instance, in the first quarter of this year, Impossible, which is a private company, raised $500 million, just like that, and Live Kindly stroke Foods United, which is basically a black box that's going to get into the chicken market in a plant-based way, raised $200 million. So money is beginning to come in a very big way here. And then you're getting companies in the established meat business, or food business, like Cargill or Tyson, are buying into these alternative meats, and because they know, they can see the writing on the wall. So a company called Purus, which makes pea protein, just had an investment by Cargill of $75 million US. I mean, these are chunky amounts. Whereas a couple of years ago, the amount of money coming into it was de minimis. And I think this is all plant-based stuff, but you're going to see an increasing amount of money coming into the cultured meat business as well. And some of these companies are now beginning to raise, you know, between $50 and $100 million in their Series A. So I think it's a very, very good area to be looking at and investing in, which is why I've written what will be the world's first investment book about the area, or I'm halfway through writing this book. It's quite difficult, actually, because the concentration levels in this, you know, lockdown environment are not as good as if you weren't locked down. Yeah. Even though you think, you know, being at home, because you go and make a cup of tea, or you get distracted, or, you know, there's something, you have to do the washing, or there's something that distracts you, whereas in a normal working environment, it's much easier to concentrate.
Most of these companies are still private, aren't they, Jim, at the moment? I mean, there are very few
but
options.
A lot of them are going to go public. A lot of them are going to go public.
I'm just wondering, are there any companies out there at the moment that might be of interest to private investors? Can you give us a bit of a sneak peek into what might be in the book? I mean, I read the other day that Kellogg own one of the biggest alternative meat companies out there at the moment, but I don't think, I mean, that's flying under the radar for most people, isn't it?
Yeah, and you've got to remember that, you know, if they do own something in the alternative meat area, and I've never heard of that about Kellogg, by the way, but maybe that's the case. I mean, I know Unilever and Nestle have their own amazing burgers and whatever they call them, which are plant-based burgers. But if they do have it, their percentage of sales relative to what they normally do is very small, so the impact will not be that great. There's a company in Japan called Nissin Foods, Nissin Foods, which is not the owner of Quorn. There's another Nissin that owns Quorn. But that's quite an interesting company from an investment point of view, and that's quite a big company. You can invest in the shares quite well. But there is very little for private investors to invest in now. But I would watch Impossible coming to the market. I think that would be a good one to invest in. I would also watch Memphis Meats, which is the cell culture business, which is very well capitalized, and I'd watch Foods United, which is called FUN, F-U-N, which is a very well capitalized, very well run business. We've also got our own agronomics, which is listed, which invests in these sort of things, and then of course there's Beyond, but I think Beyond's ahead of itself. So I'm writing it really so that when the companies come public, people will be able to look at the book and say, well, yeah, you know, he talked to this company, it looks quite good, maybe that's one to go for, or one that not to go for. So we're going to mention every single company that we can identify in the space.
Yeah.
And you're getting some very exotic ones. You're getting one that's trying to grow kangaroo meat in a lab, one that's trying to grow foie gras in laboratory circumstances, one that's trying to grow chickens from a single chicken feather. So there's a lot out there, or an increasing number out there. But it will ultimately get down to IP, and there's very little IP in the plant-based food sector. In the cultured-based sector, there's a lot more IP, and it will get down to marketing. And marketing is really important because these are going to be food products that will go up against very major companies. So my expectation is most of them will be bought out. If they're any good, they'll be bought out by the big companies, Unilever, Nestle, Cargill, Tyson. They'll be taken over because they'll all have to have their vegan stroke, environmentally friendly stroke, non-animal cruelty products in the very near future.
Yeah. Donald Trump's coming up for re-election in the US. How does the current situation with the Black Lives Matter protests play into that?
I don't really know. I mean, I am surprised about how tin-eared he's been about the whole thing. And, you know, the polls have Biden way ahead, but...
what does Biden do to the markets?
I think Biden would be... I don't know. I mean, you know, Biden... I mean, do presidents really make a big impact on markets? I'm not sure that's the case.
Certainly thinks he did.
Yeah, until it went the opposite direction, yeah. So I don't know. I mean, I would have thought that the markets will be determined by monetary policy. And although Donald Trump would like to think he's got something to do with monetary policy, the Fed is definitely an independent institution. The Fed has injected, as we know, vast amounts of liquidity. This is having the desired effect in terms of bond prices, share prices, asset prices of all types, but ultimately it will lead to inflation. In order to stop that inflation, they're going to have to tighten. And in the tightening process, a lot of this excess money will just evaporate and stocks will become more reasonably priced. So you might ask, well, what would you invest in? Because if you think the markets are, or a lot of markets are too expensive, then we get back to our old favorites, gold and silver and anything to do with them. We get back to our meta themes, including healthcare generally, because, you know, who's not going to spend more money on their healthcare given what they've seen recently? Yeah. Including, you know, I would never have invested in old age care facilities, but maybe there's going to be an opportunity now if they can be guaranteed to be safe, you know, highly hygienic we're all going to maybe at some point face putting our parents into one of these institutions.
Been told off quite heavily, haven't they, recently on the back of the care home deaths with COVID-19.
Yeah, but I listened to a webinar this morning with the chief executive of Hong Kong, which is another story, and Hong Kong's handled the pandemic pretty well. And one of the reasons is that they really make sure, because they had SARS, if you may remember, and MERS and these other diseases, and they recognized that the old people were the ones who were most vulnerable. So they really made sure they were hygienic, that there was no possibility of transmission. And they've had no deaths in their nursing homes, none at all, even though they have an old population or an aging population. And the same could be applied to Singapore, where they have a vulnerable cohort of elderly people. So it is possible to prevent this. I mean, let's get back to another point, James, which is that there's going to be another pandemic unless they do something about agricultural practices, mostly in Asia. And if we got a pandemic that was based on antimicrobial resistance, i.e. the antibiotics didn't work anymore, because 75% of antibiotics go into farmed animals, and the overuse of antibiotics means that there's resistance in us. That will be on a scale like the Black Death. It will be much, much worse than what we've seen in this COVID-19. So they need to do something about the food supply, about the food security issues. And, you know, it ticks every box as well, because it's environmentally friendly. Yeah. It creates new industries. And you can engineer all sorts of foods, different tastes, different types of foods, which are much better for the population than the crap that people eat at the moment. It's true.
Yeah. Here in the UK, we're approaching the deadline for the extension of the transition period for Brexit. Is a no deal the most likely outcome at this point?
I don't think so. I'm sure they're going to concoct a deal. I mean, my father is an ardent pro-European, and we have a Zoom call every Sunday, and he was saying, and I knew at that point, I mean, I don't know if he ever watches this, but if he does, this is true. I knew that when he said, oh, I think the pound's going to go down because there's going to be no deal and blah, 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 and they've messed up, I knew it was a time to buy the sterling, and sterling's up 3% this week. So my view is that sterling settles at around 135, which is, I think, its natural rate against the US dollar, which is about the level it was before the Brexit vote in 2016. Yeah. It spiked up a bit because they all thought that the vote would go the other way. Yeah. It went up to 141 or 142. It went down to about 112 or 113 in this current pandemic, but that's reasons to do with liquidity issues and flight to dollars rather than any reflection of the British economy. My view is they'll do some sort of deal. I really think this is a distraction issue, and but it suits the British government because the economy is depressed as a result of COVID. So any effect on the supply chains or whatever will not really be noticed if we leave the European Union on the due. We've already left it, but if the transition period comes to an end abruptly in October, November, or December, without a deal.
Good stuff.
James, we get back to the old point, which is the European Union has a huge surplus with the UK, and so they're more motivated to sell goods to us than the other way around. And they don't have a financial centre like London. They never can. They all this stuff about Paris, Frankfurt, Amsterdam becoming alternatives. It was just absolute BS, because how many people have actually moved there? Almost none. Everything's in London. Everything.
On that note, Jim, it's been a very interesting conversation, and I hope you keep yourself busy in the Isle of Man, and hopefully
I'm busy.
Hopefully, sometime soon they'll let you out.
Yeah. Oh, I mean, it's not. All you need is the cage door to be open. You don't have to leave the cage. You just have to know that it's open. That's the important thing. Okay. Thanks, James. Talk to you soon.
Thanks, Jim. Cheers.
Thanks, everyone.
Bye-bye.
Bye.